The United Arab Emirates is leaving OPEC and OPEC Plus. Plus is with Russia. Do you think gold will go down with all of it and then go back up? How will collectibles fare? We saw this with the gold and silver physical to paper market starting last January. There's still huge premiums in different parts of the world that are going like, no, we've got a different profile for demand than all of the paper that you have you have the paper gold market, which is breaking down. Then you have the physical market, 33 different global users of it. And then you have the collectible market. Today, this raw coin is going to be impacted by the spot market, by the paper market, as well as the demand market. That's why you're seeing premiums in China. This market is and always has been purely a supply and demand market. Desperate governments do desperate things, and they will do things to make themselves survive. Bank-to-bank confidence went away in 2008. The United Arab Emirates is leaving OPEC and OPEC Plus, and the plus is with Russia. But this is significant. Why is this significant? Well, not just because we do know that OPEC and OPEC Plus has controlled the price of oil by releasing more or not. Of course, the Strait of Hormuz being a choke point, that's changed everything. But the UAE breaking off, what that really is a continuation. The reason why I'm smiling is because the trend that started with the supply and demand cycle in gold that started a year ago last January, this is the next piece to fall because it'll give the whole OPEC and OPEC Plus, they've now lost all their power because they have one large producer that is more concerned about making more money for themselves because of the supply and demand issue. You know, it goes back to that affordability piece as well. This to me is I can't even tell you how big a deal it is. So what did we recently have? We recently had consumer sentiment, 2-3 weeks ago, consumer sentiment fall to the lowest level ever. How long have we been talking about paying attention to that?
Yeah, right. That being the final leg that's really holding this system up is that consumer confidence piece.
OPEC claims control, yet a core producer just walked away. The contradiction should rattle every energy-sensitive portfolio. Consumer sentiment just hit multi-decade lows while oil geopolitics fracture, a combination that historically precedes inflation spikes, not stability. Lynette Zang points to this as a confidence breakdown, but the deeper issue is institutional loss of coordination at the exact moment inflation pressure builds. For investors, that means rising input costs with weakening demand, a stagflation squeeze most portfolios aren't positioned for. Next, Lynette Zang exposes why consumer confidence is the final pillar and how its collapse accelerates everything else.
And so when that starts to falter, and to the point of the UAE leaving OPEC and OPEC Plus, that's also showing that their confidence in what they're trying to make the most of their money on is falling as well. To me, it looks like what happens at the end of a currency's life cycle.
You're 100% correct.
Right.
The systems that were put in place to control everything suddenly don't work anymore. They start to fall apart.
Right.
We saw this with the gold and silver physical to paper market starting last January. There's still huge premiums in different parts of the world that are going like, no, we've got a different profile for demand than all of the paper that you can shoot the gun if you want, because they can just make as much of this as they want to at will.
Yeah.
Oh, you're being nice.
Well,
Tom needs exercise.
I know. He's got to, it's fine. We have more time. We can shoot the gun more.
We probably will. But I want you guys to note what is happening, because this is another leg on the very flimsy fiat money stool to fall apart. It is an evolution of that trend that started with gold and silver in early 2025. It wasn't that was then, this is now. That was the start. This is another leg in it. And when you hear about that affordability factor, what's going to happen? More than likely, and in addition to, we should talk about tariffs too, so don't let me forget that because I want to come back to that in a second. But, when we're looking at what's happening with oil, oil goes into everything.
Yeah.
And so what does that mean for consumers? It means higher inflation. That's what it means. And what does that mean for the markets? Higher inflation means that consumers are more pessimistic. Right. Now, there was a report that came out this morning how something with consumer sentiment bounced, blah, 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 blah. When a system is broken, when a support level is broken, it is simply broken, period. Just because there's a bounce or they make it look like there's a bounce, right, doesn't change anything. So you guys, you have a major heads up. If you haven't already put your strategy in place and begun to execute it, get it done. You can call us and we'll walk you through based upon your goals.
This pattern showed up months before prior currency stress cycles, and we're seeing the same signals stack again. Physical gold premiums in multiple regions are diverging sharply from paper pricing, a dislocation that rarely resolves without volatility. According to Lynette Zang, this reflects a fiat system losing structural integrity. But the timing matters more. The breakdown is accelerating alongside rising energy costs. For investors, this isn't theoretical. It signals tightening liquidity and mispriced risk across commodities and currencies. Next, Lynette Zang reveals the exact sequence where paper markets lose control and physical demand resets pricing entirely.
But make no mistake about it, this is the kind of stuff that I was waiting for, and it's going to escalate. And what'll happen to people when the inflation really rears its ugly head even worse? I got to do something. I asked Kelly to make me a graph. So I just asked her yesterday, but we'll have it probably by next week. And I'm going to show you the K-shaped economy. Consumer sentiment like that, and the stock market's making new highs. Yeah, that makes sense.
Where's all that wealth going?
Well, not to the one at the bottom of the K.
Right, yeah. If it's going down, it's not going there. And to your point, like about with inflation and the tariffs and now how companies are getting reimbursed the tariffs that they paid, but that's not going
back to the consumer. Wait a minute. Didn't you pay the price on the tariffs? Mm-hmm. Not going to you.
Right, yeah. So why do you think they were able to get away with that?
Because nobody's complaining. Right?
Markets are making highs, but the consumer footing the bill is already breaking. The divergence has never ended well. Corporate margins remain elevated while real wages lag, creating a widening K-shaped split that hides systemic stress beneath headline gains. What Lynette Zang is signaling here isn't just inequality, it's demand destruction forming under the surface while equities stay artificially supported. For portfolios, that means upside looks intact until it suddenly isn't, with sharp repricing risk when consumption finally cracks. Next, Lynette Zang exposes why tariff reimbursements reveal who actually absorbs inflation. And it's not corporations.
I mean, that's why if you convert your garbage fiat into sound money, gold, and silver, that's your voice. You are voting with that voice, and you can make choices based on that voice. But if you don't use your voice, then, and that's the goal.
Right.
The goal is for this to happen in a way that there's no way for you to protect yourself. So I'm telling you, be proactive.
Yeah.
Be proactive. Food, water, energy, security, barterability, wealth preservation, community, local, to create surety and all that, because there's power in numbers and everybody comes together with different skill sets to support the whole. Right? And shelter, because you got to have a place to make your last stand.
Yeah.
And thank you for bringing the tariff thing up again.
Yeah.
So
absolutely.
let's go ahead and do the questions.
Sure.
Miramore asks, do you think gold will go down with all of it and then go back up? How will collectibles fare? Thank you. Actually, the way that it happens, and I've shown you this, but I don't have this set up today, is when they do that overnight reset, right? Then spot gold goes up, not directly to its fundamental value, but on the way to its fundamental value. On average, so I can't tell you that this is what's going to happen this time, but on average, when everything else goes down, stock markets, currency values, all of that, the spot gold will hang up there about 9 months-ish. So it's critically important, if you are working with us and you are executing the strategy, then you need to make sure that you have a good contact with your strategy specialist, because when it's time to start paying off that debt that we were just talking about, it needs to be precisely timed. So you need to be in communication, because if it's time to liquidate, and there's different ways that we're going to liquidate, and we have the ability to marry coins to create sets, which right now doesn't mean anything. But in a push to the physical markets, I mean, in the past, it's commanded up to a 30% premium.
If markets reset overnight, most investors won't have time to react. That's where permanent losses begin. Gold historically holds elevated levels for roughly 6 to 9 months during systemic resets, a window where liquidity shifts before broader repricing hits other assets. Lynette Zang highlights this lag, but the real takeaway is timing. Those positioned early capture stability, while others face forced liquidation. For portfolios, this is about execution risk, not theory, where missing the window can erase years of gains. Next, Lynette Zang reveals how collectible premiums behave during liquidity shocks and why that divergence matters.
I don't know whether that's going to be the case or not, but we wanted to set everything up so that when it's time to exit our positions, I want every single avenue there is available to us, because our job at that point is to capture the most gain that we can. Okay? So after that 9-month period, then typically, yes, it will drop down and reset like everything else, but it immediately starts to climb. I have shown you this in the past, and I can pull more charts. If you want me to, I can pull one for next week so that you can see what I'm talking about with that. But it immediately starts to climb faster and more than any of the other assets, because they still have a lot of garbage to work through.
Right.
So Ernest DeBella asks, I didn't finish answering that question. How will collectibles fare? That is a great question, because these are two separate markets, right?
Central banks quietly accumulate gold during downturns. Yet retail is told to wait for better prices. That gap is deliberate. Gold historically rebounds faster post-reset, often outperforming equities within the first 12 months of recovery cycles. Lynette Zang's analysis suggests this isn't coincidence but positioning, where institutions front-run the recovery while liquidity is thin. For investors, the risk isn't the drop. It's missing the re-entry window when momentum shifts sharply. Those unprepared often chase higher prices later, locking in weaker returns. Next, Lynette Zang exposes how institutional timing creates asymmetric upside most investors never capture.
You have you have the paper gold market, which is breaking down. Then you have the physical market, 33 different global users of it, and then you have the collectible market. Today, this raw coin is going to be impacted by the spot market, by the paper market, as well as the demand market. That's why you're seeing premiums in China. This market is and always has been purely a supply and demand market. So unless it's a coin with a very high population and low quality level, which has nothing to do with the gold content, it's the level of blemish, then this doesn't move with the spot market at all. And in fact, we've seen this over and over again, even during the great financial crisis, which you even have that chart. So if you want to see it for yourself, just call your strategy specialist and they can give you that chart where I did that comparison back then. So it's a different market. My expectation and anticipation is that this will hold up better than any markets that is guided by the paper. Though, keep in mind, that is breaking down. And that started in January of 2025. And like I said earlier, another piece of that puzzle was put in place with oil today. And it goes into effect in a few days.
Yeah.
I mean, that's not a whole lot of notice, is it?
It just kind of surprised everybody with it.
Absolutely. Absolutely. But, what does it show? Desperate governments do desperate things, and they will do things to make themselves survive. So remember we talked about the layers of confidence, right? Bank-to-bank confidence went away in 2008. Central bank to central bank confidence went away in 2015. Market to central bank confidence went away in 2022. Is this country-to-country confidence?
Yeah, right. I mean, as it starts to become that consumer confidence piece, well, what makes up a country's GDP is the consumer. So.
Yep.
Paper gold prices suggest stability, but physical premiums are rising globally. That contradiction exposes a broken pricing mechanism. Premiums in key markets have widened despite flat spot prices, signaling demand that paper markets fail to reflect. Lynette Zang highlights this divergence, yet the real issue is trust erosion between financial layers, now extending from institutions to nations. For investors, this creates a split market where physical assets retain value, while paper proxies lag or misprice risk. That divergence determines who preserves wealth when confidence fully breaks. Next, Lynette Zang unravels how collapsing trust layers redefine what price actually means.
Yep. So get ready. I can't tell you that it's going to be obvious to everybody on Tuesday at 8:35 in the morning, but it could.
Yeah.
I don't know. That's the point of being prepared. What if I'm right? What if I'm wrong? If you are in a position that it really doesn't matter, rock and roll hoochie coo.
Right.
So Ernest DeBella asks, what would revaluation of fiat dollars do to stock market? And how would that affect defined benefit retirement plans? Do those plans have clauses to lower payments when markets drop? Yeah, inside of all of these plans, what very well may happen is, well, first of all, if the money isn't there, then they can't really pay it out. So yes, there are clauses in here that is based on the claims paying ability of the entity. But a lot of what happens today and probably moving forward is that the defined benefit plan is given to the, I can't remember what that's called, but the government agency, and then whatever your payout was supposed to be, it is reduced based upon however much money they get. Now, I once had a client, well, I don't know if I'd call him, I guess he did do a little bit, so yeah, he was a client. He actually lived through that 3 times because he was a pilot. Oh. And so as different airlines that he was working for went out of business, then their defined benefit plan was given over to the government agency. And even after 3 times, he couldn't believe it could happen again.
Yeah, it's
I don't get it.
It happens with pensions. It happens with it's essentially, I know what government agency you're talking about. It's almost like the FDIC insurance of people's
right.
Defined benefit plans, but it's based on how much funding do they have access to. And so when you've got a systemic breakdown of these defined benefit plans, of the purchasing power of the dollar, they don't have it all. They've got
No, they don't.
Yeah, no.
They're lucky if they have 70%.
Right.
If pension funding drops below 70%, retirees don't just lose returns, they lose promised income. Defined benefit plans increasingly rely on underfunded guarantees, exposing retirees to cuts during systemic stress events. What Lynette Zang is signaling here goes beyond market risk. It's structural fragility, where payouts depend on entities already under pressure. For investors nearing retirement, this means income assumptions may be overstated by years or decades. When liquidity tightens, those promises are repriced downward quickly. Next, Lynette Zang exposes how pension guarantees quietly adjust during crises, and why most beneficiaries never see it coming.
And you know what? We haven't really done a piece on that in a while. I think it's a good idea to look at the pension plans.
Right.
And not just the pension plans, but the retirement plans again. Because there's defined benefit that, that was more the norm back in the day because they were trying to attract and keep talent. In my youth, I remember if you worked for IBM, you worked for them for your whole career.
Right.
My first husband, I wasn't married to him very long, but he worked for Florida Power and Light forever.
Yeah.
I mean, like his entire career, one place. Now, today, they say that people have to be prepared for 8 different careers.
Wow.
Right. And how fast are things changing? I'm glad I'm old. But so they took away the defined benefit, which actually puts the onus on the corporation, and they turned it into defined contribution. See the difference between the two? They sound pretty much the same.
But yeah, the devil's in the details with that. And speaking of that too, just a couple weeks ago, the U.S. Postal Service stopped contributing to those plans because they are cash strapped.
Yeah, I think we need to do a piece on it. You want to do it? Or
Sure.
you want me to do it? You can do it.
You do it, I do it. As
We'll
long
do
as
it
we get
together.
done. There you go.
We'll do it together.
Yeah.
Okay, we'll talk about this later.
Yeah.
So do those plans have clauses? Yeah. Those plans have clauses. The money's got to be there or they can't pay it out because they can't really pull from taxpayer funding.
Retirement security shifted from guaranteed income to market exposure, yet most investors still believe their future is protected. Defined contribution plans now dominate, transferring risk directly onto individuals while institutions reduce long-term liabilities. Lynette Zang points to this shift as structural, but the hidden reality is timing. This transition happened before systemic instability, not after. For investors, that means retirement outcomes are now tied to volatile markets at precisely the wrong phase of the cycle. Stability was removed when it was needed most.